But just understand that when you build in a cost of living adjustment into an annuity, in this case, the single premium immediate annuity, generally the starting income amount out of the gate is going to be less than if you didn't add a COLA and just went with the highest level fixed income. And so there's a trade-off, there's a compromise. To get the COLA, you're going to start with less. And we've done the analysis. Generally, there's a break-even period, similar to like Social Security. If you turn it on at 62 versus 65 or 67, the income's going to be higher the longer you wait. With the COLA, it's going to start out lower. Your income's going to start out lower, but increase gradually over time based on that percentage. And generally, it's like a 13, 14-year break-even period where the income catches up to what the highest fixed level payment would have been if you didn't go with the COLA product. So there's a trade-off. In our opinion, COLAs on annuities are a bad deal. We believe there's a better way, a far more optimal way to address the inflation concern. And that is by securing the highest fixed level payment that you can get, and then using the rest of your assets to be your inflationary buffer. Oftentimes that would include market accounts, or if you're not invested in the markets with the rest of your assets outside of the annuity, you could use a fixed product like a MYGA or a bank CD, and you can get your 5% a year and then add that 5% into your on top of your highest fixed level income annuity, and that's your inflationary strategy. So we've done the analysis, and that's a far more optimal approach. And you're really going to be in a better position because you're getting way more income out of the gate.
Yeah, and there's just different strategic approaches that we take that I think really separates how we can find solutions here for the client and their needs. And you hit on it right there.
Yeah, for sure. Now, when you look at other income annuities like the fixed indexed annuity with a guaranteed lifetime income rider, some of those products can have performance driven elements to the income rider that allows the index to influence how the income benefit grows over time. And some of the products, the income can grow for the life of the product. So if the indexes are actually doing well over the life of the policy, the index can influence that income and actually increase it over time. So while that's not guaranteed, it's all based on the markets and those indexes that you're allocated to. There is potential there to have increasing income in a fixed indexed annuity. So while it's rare that we go that route, we do speak with clients that have an interest in that. And it makes sense in some scenarios. But on the indexed annuity, you can get a guaranteed lifetime income that's a high fixed rate, or you can have a performance-driven element added into the contract on specific indexed annuities that can give you a performance driver to increase that income over time, but just know that it's not guaranteed.
Yeah, and it just comes down to those expectations, because you had hit on the point before about illustrations and how somebody can be sold on that illustration. And that's an easy way that I've seen, at least. Somebody may come to me and say, Zach, my income's going to increase by $5,000 between year one and year two. And it's just understanding that illustration is a hypothetical sometimes. It's not a guarantee.
Absolutely.
Yep.
So that'll segue into really kind of defining how annuities fit into different retirement plans. So why don't you take us to scenarios where someone should be looking at possibly securing a guaranteed income annuity, whether it be a SPIA or a deferred or a fixed indexed annuity with a lifetime income rider? How do you evaluate someone's scenario in your meeting process, Zach, to determine, A, should they be looking at a guaranteed income annuity? And if so, how much do they need? Like, how do you do that?
Yeah, it starts out with that person being honest with themselves first, and understanding we got to sit down and be critical of how this spending is going to be, whether it's now or 5 years from now or 10 years from now. And that's just crunching the numbers and looking at what life expenses we have. And listen, if you like to indulge in golf on the weekends and you know that's going to be an expense, I do it now, so it's not going to stop for me. But we've got to realize what factors are going to play into that life and enjoying it. So sitting down, figuring out what those expenses are, and is there a gap? Do you have a gap of income of what you're already receiving, whether it's Social Security or, like you had mentioned, a few who have a pension? Does this lifetime of income annuity fill that gap or that void of a stress point where you may be feeling it from pulling from another investment opportunity? So do you really do you feel stress taking that out of a market situation? Do you feel that dwindling down effect? And maybe that's where an annuity with a lifetime of income provides some value and some security for you.
Well, I think that's a good point. And I don't think it's often discussed enough. I urge our advisor team to really talk about this in our meetings because it's a great point, and that is asking a question of when's the last time you took a withdrawal out of your 401k? And a lot of times you're going to hear an answer that is, I never have. And for some, and for most, at least the people we speak with, that can be an uncomfortable situation. The reason is because it's new. We've never done it before. We've never had to do it before because we've had earned income through our employment and we've had paychecks, right? Like we had paychecks every 2 weeks or every week or every month, or however you get paid. So we've never had to tap into the 401k or the IRA or the retirement nest egg, right? And so it can be uncomfortable. You add in the fact that your money, your nest egg is invested in the stock market in some capacity in most cases, some more aggressive than others. But what adds into that now is a recipe for poor performance, because if you're in the markets, you have risk. And so if you add in taking withdrawals from your market accounts and the markets are not doing good, they're in the red, that's going to be a very tough trigger to pull, right? It's going to be a very tough click of the mouse when you go to hit withdrawal once you're logged into your Fidelity account and see that all of your stocks or bonds or whatever are in the red and you're still having to take income. So now you're actually compounding your loss. The stock's down, you're taking income out, so you're selling more shares in a down market to get the income. So you're selling more shares to get the same amount of income that you need. And so you're actually compounding your losses. You're actually having the reverse effect of dollar cost averaging. You're reverse dollar cost averaging, if you think of it that way. And that's very uncomfortable for most people. I know I wouldn't be able to do it, but that's where the annuity, the income annuity is the hero. That's its role. Think about this. If you can secure enough guaranteed income between Social Security, a pension, and a guaranteed income annuity that covers all of your living expenses to sustain your lifestyle that you've worked hard to build and attain, and you have these sources now paying for it, no different than your paycheck when you were working. Well, think about the optimization that occurs there. You're able to look at everything with a clearer lens because it's no different than in your working years. You have a paycheck. It's just instead of your employer signing your paycheck, it's the Social Security Administration. It's your pension company, if you have one, which most people don't. And then it's your insurance company or annuity provider that's paying your income from the annuity contract. And what's neat about it is the optimization on the peace of mind and the clarity and confidence that gives somebody. But also, it's a lot less stressful, right? A lot less stressful because they're not having to take uncomfortable withdrawals from their market accounts and having to do so in potentially unfavorable market conditions. And then the third element of that, and where the other optimization comes in, is on the remaining assets that are not in the annuity. Those can be now used and leveraged in a much more aggressive manner risk tolerance speaking, which we all know that the more risk you take, the higher the reward. The more risk you take, the higher the growth potential. But it does a few things here. You can risk on now on those remaining assets in your market accounts. So if you want to go all stocks, you can. Not saying you should. It's going to be based on your comfort level and your risk tolerance. But it affords you to have a higher risk tolerance because you did the right thing in risking off enough of your assets to build your first pillar or first building block of your retirement pyramid. And what's neat is that the other thing it does is in your market accounts now, if you choose to be more aggressive there, the other thing it does is it gives you the wherewithal to ride the ebbs and flows of the market. We know the market goes up and down, up and down, up and down. It will forever. And now more than ever, because of how quickly we can get information about things that can dictate the markets and the returns of them. So what it does is it builds in the wherewithal for you to stomach those ebbs and flows and really just set it and forget it and allow you to manage that market account completely differently. Why that's so important is we find that when people are in retirement and they don't have guaranteed income, or at least enough to cover their living expenses, they're forced to sell positions in the market. And what happens is they're trying to play the game. They're having to worry about when they should be in the market and when they should get out. And that's a recipe for disaster, because what happens is people don't make the right decision. They're not proactive, they're reactive. And when you're reactive, you make a bad decision in most cases because you're reacting to something bad that happened in the market. So you're already in a bad position because whatever happened already happened and you're having to react to it. And so when you have this independency that's created between your market accounts and your income, it allows you to set it and forget it. Do you remember that old infomercial? It used to come on, Zach, when we were in college.
Forget it. Yeah.
The Ronco.
Yeah.
So remember Ronco is like that turkey roaster or chicken roaster, whatever it was.
Ronco Peel? Was that what it was?
Yeah.
Yeah.
And his whole claim to fame was set it and forget it, right? You put it in this rotisserie thing and you click the timer thing and then it comes out perfect every time.
Right.
Well, when you have this independency from the market, you're able to set it and forget it. You don't have to log in every morning. I know you guys watching this episode right now, you all log into your stock account every morning and probably throughout the day several times. Why? Because you're uncomfortable maybe, or maybe you're worried about what the market might do. When you think of the annuity and the role it plays, it allows you that even if the uncontrollables happen, you don't have to worry. You don't have to make a bad decision and selling out of the market. You can set it and forget it. The only time you lose is when you sell your shares.